Hello everyone, I hope you guys are doing well and studies are going in full swing. Now this is a very important video for CA Final FR, especially for May 24 students, where we have tried to kind of outline the 5 or 6 important changes that the institute has done very silently and subtly without giving a separate corrigendum or an amendment notification in the May 24 material. So this has been there in the May 24 material. It is not that they have done it now. This has been there in the material. However, we have been receiving queries from the students when they compare it with the older material, or maybe whichever class notes you are referring, the older class notes, whereby everyone would have solved probably based on the old study material. So we have tried to compile the 5 or 6 important changes. Again, the minor cosmetic changes, etc., we have not considered. We have just considered changes which impact the solution or changes which impact your understanding of the question and thereby impacting the solution per se. So I would strongly recommend that you kind of go through this video. More importantly, I will share this PDF on the Telegram channel. Just refer that. It's a 1-pager PDF only, so that you know what are the important changes that you have to remember for your exam. Most of these are logical and correct changes which were earlier errors which they have now rectified. So please do ensure that you refer that, and in case I have missed something which is material, please do share it in the comments box so that it can be incorporated for the benefit of the wider student community. Okay, so keeping that into consideration, major part of these changes pertain to Ind AS 20 government grants, Ind AS 33 EPS, and there is Ind AS 102 share based payment. First we'll discuss about Ind AS 20. In case of government grants, there's a fairly interesting and important question which is there, which was there in the study material test your knowledge 8. I think in our books it was question 9 or so. In this question, you had a government grant of 60,000 rupees, which was receivable 40,000 now, then 10,000 in each of the years, and there was a certain treatment which was prescribed by the earlier study material. Now, what has the institute done? We have just explained that. What I will also do is I will share these relevant pages or extracts from the institute study material so that you can compare the 24 and the earlier 23 or 22 material, so you clearly know in a matter of a few minutes what are the changes and what you need to do for the exam. So at this point, I'm not going to discuss the entire question, solution, concept, etc. I'm just going to focus on what are the differences. So over here, this was a case where you had a grant, and in the older material, there was no specific guidance. What the institute was earlier doing is, whatever was the grant received, they would calculate your deferred grant based on that, and then while amortizing income, they would take the entire 60,000. Now what they've done, rightly so, is have added 2 points, point A and B, where they have said in point A that if there is a reasonable assurance that entity will comply the conditions attached with the grant and the grant will be received, in which case they have taken the entire 60,000 for the purpose of calculating deferred grant balance in the balance sheet as well as deferred income to be amortized in the profit and loss account, and in my opinion that is absolutely right. So this is the solution which has been newly added, at least the part A1 of the solution is been newly added, and it is a more appropriate and logical solution. We have also done this alternative in class, but now you can do that officially with the assumption that there's a reasonable assurance that the conditions will be fulfilled and the grant will be received. But what if we are not very sure whether the grant will be received or not, in which case what the ICAI has done and what it was doing earlier, whether it is right or wrong, this is not the time to debate. We are just going to do that. What if this comes? How are we going to probably address this in the exam? What the ICAI has done over here is, you have, while recording income, they have recorded income based on the entire 60,000, but while recording a deferred grant balance, they have recorded based on the amount received. So in the first year 40,000 is received, by the second year 50,000 is received, and the third year 60,000 is received. So you can just refer the solution. This is the second part, is the same as, let us say, the old ICAI SM. So what is new is the correct first part which you should refer, and in case the question specifically gives you 2 subparts, then you will solve accordingly. So this is for Ind AS 20. We have given a detailed explanation of the changes over here. 2 possibilities given by the ICAI and the treatment under the 2 possibilities, and what was the treatment earlier, so you can refer that as well. Second, there are a couple of changes, 2 notable changes, and third, more of a clarification change in Ind AS 33, that is on EPS. In illustration number 2, this is a fairly popular question or illustration, if you go to see over here, where you had different types of preference shares and you were supposed to find what should be deducted for the purpose of calculating net profit. The general rule over here is, if the preference share is in the nature of liability, then any payment to them, whether it is preference dividend or a premium on redemption, etc., should have been adjusted in finance cost. And hence, if net profit is given, I don't need to adjust anything separately. However, if these preference shares were in the nature of equity, then ideally, the preference dividend as well as any premium on redemption or conversion would have gone into the retained earnings, because it is an owner to owner transaction, payment towards the owner's equity items, and hence, for the purpose of calculating net profit for the purpose of EPS calculation, you need to deduct it separately, because it might not have been subtracted for finance cost. Now, for this, we had to earlier remember a rule to keep it in line with the institute solution. However, here they have amended it and made it correct, where in point number 7, if it is cumulative convertible preference shares which are in the nature of equity, and in this case there is a premium paid to induce conversion, so a premium of 100 shares, fair value of 300, that is 30,000 paid, so that the conversion can be induced. Now this is a payment made to preference shareholders which are classified as equity, and hence this payment would have ideally gone into the reserves, and hence for the purpose of net profit calculation for the equity shareholders, for EPS purposes, you need to subtract it separately. So as you can see over here, that same 30,000 has correctly been subtracted in the amended institute material. However, if you kind of just put a reference to the old institute material, if you go to see over here, what they've done is they've directly taken 18 and 1, they have not really subtracted anything separately for 30,000. Now thankfully they have subtracted it correctly. So if this comes in the exam, you should subtract the premium on early redemption. So the rule that you will follow is now a logical rule. You don't have to mug up anything just to keep it in line with the institute solutions. You will logically say that if there is any preference dividend or premium paid for preference shareholders which are in the nature of equity, it must have gone into the retained earnings. If it has gone into the retained earnings, not as finance cost, then for the purpose of EPS calculation, I need to subtract it separately. Perfect. Bang on. So that is illustration number 2. In illustration number 1, there is a small, I would say, clarificatory change. So in illustration number 1, what was happening is, so this is illustration number 1, there was a case where there was an early redemption of preference shares happening, because of which you had to pay a 1 rupee premium. And they would say that this 1 rupee premium should be deducted. A lot of times students would argue, and rightly so, that if there is a premium for preference shares which are in the nature of liability, it would have gone into the P&L. Institute has said that we will ignore the applicability of Ind AS 109, but at the same time, now they have clarified that the additional payment is at 12 minus 1, if you see this question, that is 1 rupees, would be made from securities premium or reserves as a case may be, which means the company would have adjusted this additional payment from the securities premium or reserves. However, for the purpose of EPS calculation, I need to subtract it from profit, and hence only to that extent of 1 rupees, the answer remains the same, that 1 rupees is subtracted. So this one line is added in the question more for a clarification purpose. I would not really put a lot of emphasis behind this change. Your solution does remain the same though. And the third, and I would say among all of these, the most important change is in EPS question number 14. Again, I think question 1 and 2 are similar to, if I'm not wrong, question 6 or 7 of our material. 14 is also similar to, I think, question 14 or 15 of our material, where there is an optionally convertible bond and it is optionally convertible at the issuer's choice. In general, in CFI, most of the sums that you have are either compulsorily convertible or they are optionally convertible at the holder's choice. This time around, it is optionally convertible but at the issuer's choice. Typically, in such cases, your classification, when we look at for a compound financial instruments, for the purpose of coupon, we have a contractual obligation to deliver cash, so that will go in the liability component, but the question arises in case of principal. For compulsorily convertible, we do not take it in the principal in the liability workings, because we don't have any contractual obligation to deliver cash. In optionally convertible at the holder's choice, we take it because if the holder demands, we have an obligation to deliver cash. The challenge arises in case it is optionally convertible at the issuer's choice, where fundamentally we should try to solve based on the intention of the issuer, whether they want to settle in equity or whether they want to settle by payment of cash. Now earlier, what the institute used to do, and what might have been done even in an earlier RTP as well as in the earlier study material question is, and maybe that is the assumption we kept consistent for the purpose of our solving, was that if nothing is given, we will assume that, well, the issuer might deliver cash, and hence we will show the principal value within the liability component calculation. Now in this study material, they have updated, amended it, and they have still written an assumption. It is still an assumption, mind you, that assuming the settlement happens by issue of equity shares. If and can the issuer decide that? Well, yes. So if the issuer assumes to settle in equity shares, then I don't have any contractual obligation to deliver cash on the principal, and in that case this principal will not go into the liability component measurement, and as a result ICAI now considers the principal part of an optionally convertible bond which is convertible at issuer's choice to be in the nature of equity, assumption given in the notes, and does not consider the same in liability calculation, and hence your answers change to that extent. But if you want a standard assumption for the institute, this is a very interesting thing. Like if you see this question, I am sure you would remember this, it's an important question, in which case over here when you calculate the liability and equity component, when you're finding the liability component, it is now merely 3,03,000. Earlier when you calculated the 3,03,000, it is 1,20,000, and you will also add the principal. Now as you can see, they said it is presumed that the issuer will settle contract by issue of ordinary shares, and hence you have calculated your liability component by taking only 1,20,000, which is your coupon, into the PVAF. There is nothing towards the principal which has been separately added. But if you open your old study material, if you go to see these numbers are slightly different or significantly different. If you open the old material, they have over here taken the entire value in the liability component working. So they have taken this 1,20,000, and additionally they have also taken this 20 lakhs, and as you can see, instead of 3 lakh, your liability component comes to 18 lakhs, and that is why your interest also changes significantly. So this is a fairly important change. In case any sum, not just over here, anywhere comes regarding optionally convertible instruments at the issuer's choice, we know what the assumption, at least the latest assumption, what the institute is taking. So these are the changes when it comes to Ind AS 33. Next you have a change in Ind AS 102. Again we have discussed this change earlier. In case of share based payment, in cases where you had plans with cash or equity alternatives, what did we do? Usually, well, we would treat the plan as a cash plan, we would find the value of an equity option, record the expenses, and then ultimately there could be a cash settlement or a share settlement. If there's a cash settlement, the entries would be clear: SBP, liability account, debit to bank. The balance in the SBP reserve, earlier they would say transfer from one component to equity to another. Now rightly so, they said they should go to the retained earnings. No problem in that. What used to happen earlier was, when an equity option was exercised, they would still transfer the balance in the SBP reserve to retained earnings. Now they have updated the treatment, and in my opinion rightly so, we have probably discussed that separately as well, that it should ideally go to the securities premium because you are issuing shares. And now in the study material they have updated it to say that, well, in case you are settling through issue of equity shares, then at the time of exercise we will take it to the securities premium instead of retained earnings. Having said that, there is a past suggested answer question where I think May 23 or so, where they have given both the alternatives. So if it comes in the exam, that is a cash alternative and or an equity alternative, and the employee decides to exercise equity option, then at the end, if you see, this is a question 6 from your Ind AS 102. In this case, what you will do, ultimately all else remaining constant, is at the end SBP reserve account debit to securities premium. Alternative scheme of entries can also work, but this will go to the securities premium if the equity alternative is kind of chosen. The same treatment if you see in the older material, and they would have taken this into the retained earnings. As you can see over here, the same 3,60,000 was taken into the retained earnings. So we have mentioned in the update that balance in the secured SBP reserve to be taken to the securities premium instead of in case of eventual equity option. Earlier it was getting transferred to retained earnings. Remember, if the cash option is taken, then we will still take it to retained earnings only, because this is like lapsing of the equity option. And the last one is not really, I would say, an amendment. However, if there is a question, I think this was similar to question 57 of our books. This is a very tricky illustration, two illustrations which were there in the institute study material in Ind AS 109 of the old SM, which they have deleted. So that does not mean that they are not applicable. In my opinion, they are still applicable, but there was controversy in the treatment in question 57. I'm not going to go into that right now. We have even written an alternative view, but now they have been deleted. The theory for this still continues to be applicable, in the sense they've written the theory. So over here, if I just bring up that in front of you, so this is a question which probably you might have seen, where there was a parent holding a 70% stake, remaining 30% was held by some other company. We wrote an option to buy that share, for which a special case was applicable, where we had to record a liability, then record some commitment to buy back other equity, etc. If you go to see this question number 14 as well as a similar question number 13, they have been deleted by the institute. So if you open the same matter over here in your study material, we still have the theory is still retained. However, the sum etc. has been deleted, maybe because of the controversial application. So the essence of telling you this is, if you are kind of getting baffled and hung up and stuck up at this illustration when you do question 57 of our books, or this illustration number 13 on 14, and you are kind of stuck up that, yeah, why is this? Just remember the treatment that what you have done. If you have not done it, no worries, but just remember the treatment and proceed, because if the institute has deleted it, hopefully that is a lesser probability of that coming in the exam. But being the institute, you don't know what the institute can do. So if you've already prepared for it, just remember and proceed. Don't really rack your brains behind that. Okay, so these are the important changes. There are a few other cosmetic changes, etc. In terms of the additions, most of the additions for in the May 24 material are from the RTPs or suggested answers subsequent to 22 and 23. However, in Indes 12, income taxes, 3 very detailed examples, the ones similar to what was even asked in question 13 of RTP May 24 have been there. I would strongly recommend that you kind of cover that. We have also recorded and shared a separate video for the new sums of Indes 12 separately, so you can refer that if that helps. Otherwise, the RTP of May 24 question number 13 is a much more easier or a manageable sum as compared to the examples. Otherwise, don't really worry more about the May 2024 changes. I think this will help you at least get some clarity on what are the changes that you will have to remember, at least from an exam solving perspective, most notably in the EPS chapter, maybe also in the government grant and your share based payment chapter for specific items. Okay, so that should be it. Thank you very much for your time, and I'll see you soon with more updates. Till then, bye bye, take care and keep studying.